Ladies and gentlemen, good day and welcome to Q3 FY26 Kross Ltd Results Conference Call hosted by Equirus Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mir Vora from Equirus Securities. Thank you, and over to you, Mr. Vora.
Yes, thank you, Nirav. Good afternoon, everyone. On behalf of Equirus Securities, I welcome you all to the Q3 FY26 Results Conference Call of Kross Ltd. From the management side, we have with us Mr. Sudhir Rai, Chairman and Managing Director, Mr. Sumit Rai, Whole-Time Director, and Mr. Kunal Rai, Whole-Time Director and CFO. So without further ado, I now hand over the floor to management for opening remarks. Over to you, sir.
Yeah. Thank you, Mir. Good afternoon, everyone. Thank you for joining us on this earnings call of Kross Ltd for the quarter and 9 months ended December 25. Along with me, I have Mr. Sumit Rai, Whole-Time Director, Mr. Kunal Rai, Whole-Time Director and CFO, as well as other senior team members and our investor relations advisor, Strategic Growth Advisors. Let me first update you on the performance and the industry which we operate for the quarter and 9 months gone by. Supported by a favorable microeconomics backdrop, including GST rationalization, a healthy monsoon, a steady improving demand environment, the company delivered a strong performance during the third quarter of FY26. Revenues for Q3 FY26 stood at 177.5 crores. This between Q2 and Q3 of FY26 has seen an increase of 37%. And if you compare it with our year-on-year Q3 results, it is 18.3%. Our EBITDA also has seen a growth margin, and its current margin is 13.2%. For the 9 months ended FY26, the company reported a revenue of 447.8 crores, reflecting a year-on-year growth of approximately 3%. EBITDA for the period stood at 54.4 crores, with a margin at 12.1%, underscoring sustained operational discipline despite a transitional demand environment in the early part of the year. For the first time in 7 quarters, the company witnessed growth in the M&HCV segment. The segment has remained subdued over the past 7 quarters. However, from October 25 onwards, both key OEMs, Tata Motors and Ashok Leyland, have reported sharp increase in production volumes. The production projections for Q4 FY26 is also encouraging. The increased demand within the M&HCV segment is largely driven by dumper, tippers, and prime movers, which is well aligned with the company's product portfolio. As a result, the company expects H2 FY26 revenues from M&HCV segment to be significantly higher than H1 FY26. The company's capacity expansion initiatives continue to progress in line with the planned timeline. Trials for the axle beam extrusion plant are currently underway, with commissioning expected by February 26. Upon commissioning, the facility is expected to enhance axle manufacturing capacity by approximately 50%. In addition, construction of the seamless tube facility has been completed. During the quarter, the company further diversified its product portfolio with the launch of a key product in the trailer segment, the tipping jack. This addition is expected to strengthen the company's positioning within the trailer ecosystem and provide incremental revenue opportunities beginning FY27. The manufacturing facilities for the product has been fully installed, production has commenced, and the product is currently undergoing validation phase. The company also expanded its forging capabilities by commissioning a 2,000-ton screw press, a 1,000-ton screw press, and now additionally a 1,600 screw press is under commissioning, and it will be completed in the month of February. These investments expected to enhance our forging capacity, improve operational efficiency, and support future growth across product segments. On export front, the company achieved meaningful progress during this period. Purchase orders were secured from a leading Tier 1 company in Europe across two distinct product families. Samples were successfully dispatched, and the supplier has approved. The supplier approval has been obtained for one family of parts, against which trial orders have already been received. Exports contributed 4% of our total revenue during FY26, that is for the 9 months, registering a growth of 14%. The company remains confident on achieving its full year export contribution of 5% and has laid out a clear roadmap to scale exports to double digit by FY27. The trailer segment has also witnessed a noticeable pickup in demand, further supporting volume growth in the second half of the year. The company added 5 new fabricator customers during the quarter. Continued focus on expanding the fabricator customer base is further strengthening the market penetration and improving demand visibility in this segment. The agri sector is operating at a high level of activity. The company's tractor segment delivered healthy revenue growth of 16% during the 9 months of FY26, with strong momentum carrying into Q4. We have also witnessed an earlier than usual improvement in the schedule visibility, with OEM production schedules increasing meaningfully from February itself, which typically accelerates from April. Over the next 2 years, the company aims to increase the tractor segment contribution to approximately 15% of its revenue. Overall, customer engagement continued to reflect a strengthening demand environment, evidenced by higher production schedules and increased inward volumes. This positive movement has extended into quarter 4, with schedules for the quarter remaining healthy. Combined with an improving working capital cycle, new product launches, a healthy order book pipeline, and ongoing capacity expansion, the company remains confident of delivering a strong performance in the fourth quarter of FY26. With this, I'd like to hand over the call to Mr. Kunal Rai to update you on the financial performance for the quarter and 9 months ended December 31st, 25.
Thank you.
Hi, good afternoon, everybody. Let me take you through the financials and take a moment to walk you through all the key performance indicators. Speaking about the quarter 3 first, revenue for us stood at 177.5 crores, reflecting a growth of 18.1% on a year-on-year basis. EBITDA for the quarter stood at 23.5 crores, representing a year-on-year growth of 18.9% compared to 19.7 crores in quarter 3 of FY25. EBITDA margins for this quarter stood at 13.2%. Profit after tax came at 14 crores as compared to 13.6 crores in Q3 FY25, reflecting a growth of approximately 3%. And the margins for this quarter are at 7.9%. The revenue contribution in terms of a sales mix from trailer axles and suspensions stood at 40.7%, while the other component business, which includes CV components, exports, and tractors, stood at 59.3% in quarter three. For a 9-month period, the revenue stood at 447.8 crores, which is approximately a growth of 2.8% on a year-on-year basis. EBITDA stood at 54.4 crores as compared to 54.5 crores in 9-month period of FY25. EBITDA margins for the 9 months were at 12.1%. PAT came in at 32.8 crores as compared to 30.9 crores in 9-month FY25, reflecting a year-on-year growth of 6.1%. The PAT margins stood at 7.3%. For the sales mix for the 9-month period, the revenue contribution from the trailer axle and suspension business stood at 41.3%, while the rest is at 58.7%. Just to update our investors on our IPO proceeds, we have approximately spent 90% of the proceeds. These have already been deployed, and the balance 10% will fully be deployed within FY26, which has been previously guided by us. We thank everyone for their continued support, and we now can open the floor for further questions and answers.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. First question is from line of Akash from NV Alpha Fund Management. Please go ahead.
Yeah, thanks for the opportunity. Sir, 2 questions from my side. Firstly, on the new product we launched for tipping jack, which we did in December, I guess. So, just wanted to understand about the product acceptance currently. What are the what kind of validations will be required? Where are we currently at that stage? And what are the break-even volumes we'll be requiring? And when do we target to achieve those break-even? So, yeah, just if you could give some color on that.
So, you see, we started this project in this financial year only. In fact, we started installing all the equipment in June, July. And during this very short period, we have come into production. Now, since we are already in this trailer segment business, and the product will be used by the same customers as the fabricators, our existing fabricators, for their trip trailers. So, but what is correct, how it is to be done is we have testing equipment. Pardon? Sorry. Is he asking this question from us? Hello, am I audible?
Yes, sir, go ahead. There was some disturbance from the participant's line. I muted the line. You can go ahead, sir.
Okay. So, during the installation of this plant, which has taken us up to, October, October this year, we had the whole plant installed. Now the product is under validation with a few of our known customers who are willing to use the product and also give us the feedbacks on its performance. We will like to launch this product sometime in January or February this year. We have already, dispatched close to about 35 or 40 assemblies in the field. And as far as our capacity for manufacturing these tipping jacks is close to 800 assemblies a month. Okay. It will take us maybe the whole financial year FY27 to come to the peak capacity. But otherwise, currently we are at, I think so, close to 350 to 400 units. That is from the time we will start producing in bulk. Currently, we are awaiting our validation of this. It's a highly safety item, so we have to go through the process of validation. Unfortunately, you don't have an external agency like ARAI which validates this part. Okay. In fact, validation of the trailer axle is done by ARAI, but not for the tipping jack. So here the validation has to be done by us. The second part of the business will start maybe in the next 1.5 years, after 18 months, when we will approach all the OEMs also for this product. So there is going to be a long story of development on this assembly.
Understood, sir. Just if you could indicate what sort of volumes are we planning for this year, that is FY27, before I move on to my second question.
Yeah. So, like we had indicated to you that we will reach our peak capacity within a year's time, that is 800. So in Q1, we will produce close to 750 units. That is an averaging of 250 units a month. Okay. And as far as producing the components are concerned, I told you we have a laid out capacity of 400 units a month, and we can take it up to 800 units a month. That is when we go to the peak capacity.
So at what utilization we break even generally? Like what level we break even?
So it's like this, we have a utilization, for all the brackets which are used, we are doing the castings ourselves. All the trunnions which are used, we are doing the casting and forging ourselves. There is a lot of backward integration available with us. So it's very difficult to, say what is the utilization. There are dedicated, you could say 6-7 machines which are for this application. But we have to get all the child parts, all the inputs, all the pumps and all that ready. That is where the problem is. I mean, as far as the top limit is concerned. In fact, for this quarter, that is Q4, we have a plan to do 300 units also. We have a plan for Q4 of this financial year to do 300 units.
Understood. So just if I want to understand the product at a margin level and EBITDA margin level, what will be the delta to the current margins on a consolidated that we do as compared to a tipping jack?
As far as margins, we have let's say a total backward integration. When our tubes are going to be made, we will have the seamless tubes also. Okay. Even we will be backward integrated to that extent. We have all the forgings, the castings, and I have all proprietary items like pumps and valves. They are going to be bought out for us and also our competitors. Okay. Now, as far as margins are concerned, we cannot price ourselves more than, say, the market leaders. So we have to take margins at a time once we, penetrate into this marketing and be a number 2 player. Then we can talk in what type of margins we will earn. But just, predicting our margins when we are producing, 200, it doesn't make any sense, we are looking at a bigger picture. We are looking at this contributing to our top line in the next 2 years, a hefty amount. And margins should be calculated looking at that, not what we are doing currently.
Understood. Just one last question before I move on to the queue. Uh, Sir, on a 9-month level, 9-month basis, if we compare our other expenses as a percentage of sales, I think it has moved up significantly by almost around 250, 300 bits. So, what could be our levers to, reinstate our EBITDA margins to our initial levels? I think we had achieved around a 15% kind of a level last year in March in a similar scale of top line.
Right.
Yeah.
So just speaking on the other expenses, if you look into it as a percentage, firstly, our other expenses for quarter three of FY25 were at approximately 24.5%, which has now gone up to 26.5%. If you look into the preceding quarters of quarter one and quarter two, they all stand at around 26.5% and in fact 28% for quarter two as well. Now, just to give a little flavor on the other expenses, which basically constitute into these are a large variety of consumables and spares. Now, we have a lot of ongoing projects, things like the extrusion, new components for the exports, that is for LEX, even the tipping jack business, which has just started off. There is a lot of consumables like the tooling and everything which goes into for these, which have basically, come into our cost, but not reflecting in terms of our top line yet. And once we do start these projects, from quarter four and quarter one onwards, you'll see these expenses remaining the same, whereas our top lines will go further up and then will contribute to a similar margin of approximately 14 to 15% in this quarter four as well. That's what we are targeting. Apart from the consumables, there are certain other expenses like the power and fuel and the freight expense, the traveling expense. We are consistently increasing our reach in our trailer segment to other states, where we have not been very present. So, in fact, we feel that the expenses will remain the same now, since most of these projects now have been set up, and these will further contribute towards the revenue side, and hence then we'll be able to have margins closer to the 15% for quarter four as well.
Understood. Thanks, sir.
Thank you. Next question is from line of Ankur Poddar from Swan Investments. Please go ahead.
Hi, congrats on a good set of numbers. I have a few questions. First is in terms of our exports, which we are targeting of over 5% for our full year. And so can you just help me with what is the duty which we are currently on our, which is levied on our components? And is there any clarification on the FTA, like how the duty will move going forward?
Okay, so on our exports, which we are targeting at 5% for this year, it is going in line with what our plans were. Now, most of these exports, Ankur, is that our exports are 99% to Europe, okay, and they are not to the US. Now, the custom duties which we have been paying is we don't pay. I mean, obviously, what the customer pays is approximately 0 to 4%. Okay. Now, coming in with this trade deal, which is being discussed between the EU and India, we obviously need to wait as to what exactly are the entire guidelines which do come out. But it's not that we benefit too much from it yet, in the sense with customers like LEX, we already have the order book in hand, and it's now a process to ramp up on those volumes. Okay, we've mostly secured all the businesses of these 4 components that we are doing. Similarly, where the other business has started, it's just at the stage of sampling and sampling and validation of these components which we submitted. Obviously, we will wait as to once these are completed, these will give us meaningful revenues from Q1 onwards. So with this deal coming in, we need to wait a little to find out what exactly how it benefits us. But at least we are fortunate right now. We don't have this exposure of 5% into the US market. It's better that we have it in the Europe only.
Understood. And my next question is regarding our forging capacity. So we have added 200 ton screw press and 2000 tons screw press and 1000 ton screw press, with another one scheduled for Feb. So what would be our total capacity going forward, and what is the utilization levels currently?
The utilization levels in the forgings, are at approximately between 60 to 65%. Okay, we usually plan our forging infrastructure a little in advance because it takes time to install and commission these machines, and most of these machines are imported for us. The regular machining capacity utilization is at around 70%, 70 to 75%. But what happens in the machining infrastructure is you can add it as and when you like, because mostly these are CNC turning VMC centers where you can get delivery of these in a span of 30 to 40 days from the machine manufacturers. So utilizations with all our businesses, doing well in the sense, especially the commercial vehicle segment in Q4 has seen a sharp increase. Tractors are going to follow the same. Trailers has seen a huge spike as compared to Q2, which also uses a lot of our forging capacities. With the addition of these three presses, we will be at around 65 to 68%.
All right. And next, regarding our trailer segment, so what were the volumes for the quarter and the axle volumes, and also what is the run rate that we are seeing in Q4 in Jan, if you could help me with that?
As compared to, if you look into what our Q4 volumes are, at least we're looking at a volume of 4,000 axles a month. This is the kind of an order book right now we have as compared to, if you see what February and March, what we are planning here is 4,000 axles on a monthly basis. If you look into Q3, we have done approximately 8,300 axles in Q3. Revenue-wise, if you look into our axle business, in H1 we were approximately 12% down as compared to H1 of FY25. But if you look into a 9-month period, we are just 1.5% down now. We've done revenues of around 185 crores as compared to 188 crores of FY25. Volumes from Q2 to Q3 have increased by 26%. And if you look into Q3 versus Q3, business has become better by 21%. We did a top line of approximately 72 crores versus 59.5 crores in Q3 of FY25. So it's obviously helped because the entire CV volumes have picked up, but it is picking up further in Q4, although a lot of dumpers and tippers are being made within these OEMs. But for sure, whether there is a growth in the volumes, a bit of it might be in terms of market share also. And I think once the extrusion line starts by Feb and March, then we should be able to see even better volumes coming in.
Thank you. Ankur, can I request to come back for a follow-up question, please?
Sure. Thank you. Thank you, Kunal.
Thank you. Next question is from the line of Pritesh from Lucky Investment Managers. Please go ahead.
Yeah, hi guys. So, right. So just with the extruded axle line now becoming operational, one question is on the not the component side, but on the trailer axle side of the business, which is 40% of your business, 40% of your business. There, if you have to map your growth rate with the CV prime mover growth rate, with the new product which you are introducing, what should be the multiplier in terms of volume? It's a fair guess that you can make. Will you grow 1.5x? Will you grow 2x the prime mover growth? And second question is, is there any pricing premium that you would command on extruded axle versus a welded axle today? Or as a market penetration strategy, both the products will be equated as pricing. This will give us a fair guess on what should be the growth in your axle side of the business, which is about 40-45% of your business. I'll ask the other two questions later. Maybe you want to answer this first.
I'll just, hi, this is Sumit here. I'll just reply to the first question first of with the extrusion line starting. What is the increase in sales volume sales volume that we expect for the trailer axle? I think that was the first question. So look, at the moment we are at around a 26 to 28% market share in the Indian market, right? And the market leader is at about 40 to 45%, around 45% market share. So we of course want to become the leaders in the market, but what we will be looking at will at least we would like to reach a market share of about 35% with this improvement in technology. Whether we can demand a premium for this product, of course we would always like to demand the premium on the product, but to the customers we have to show a better performance of the product, which of course we are committing to our customers. But I think this premium would probably have to come in at a slightly later time. If we add the premium today, maybe the acceptance of this product is there in the market, but then we will sort of be missing out on increasing our market share, at least for the first 6 months of introducing this product to the market. We don't plan on charging a premium immediately. So I think when you talk about multipliers, we have not kept a multiplier in our head, but we are looking to grow our market share from about 26 to 28% to a figure of 35% is what we are looking at. We are also looking to explore export markets with this product. So we have an installed capacity of 7,500 extruded beams with the line which we have set up right now, and we are at a current volume of 4,000 axles per month. So we in the next 1.5 years we should be or in the next end of next financial year we should be looking to utilize this whole capacity of ours of 7,500.
And
could you repeat the second question?
I didn't ask the second question. My second question is with respect to the 55% components business, which is in turn linked to tractors and CVs, and also the export. So one, what is the progress on the export order that you had which was supposed to bring you a revenue of about 100 crores. So what is the progress there? What level have you reached now? And second, what are the incremental developments on the domestic CV component side, if any? Are there any for which you can grow faster than the CV tractor market growth rate, or you will grow in line with the CV and the tractor market volume growth rate? Is the question.
Right. So this is Kunal here again. We have, as far as our component business, we have a very diversified component base, okay? And we should grow faster than what the market is, okay? In terms of the overall growth in the CV industry, we should be faster than that. I'll give you a few examples. We do an anti-roll bar for one of our customers. And a year back, that was used at around 2,000 a month. And now with the cabins, with all the air conditioning in, they've converted those cabins to 5,000 to 6,000 a month. So there are certain product lines within our component business which are going to grow faster than the cycle. And if you look into just our figures, boss, within our component business, in the CV component...
Sir, sorry to interrupt you.
Yeah.
Ritesh, can I please request you to mute your line from your side?
Okay.
Sir, sorry, please continue.
Yeah, within the component business, in the CV components, in Q2, we had done a revenue of approximately 48 crores. And in Q3, we've got that revenue to 82 crores. That's a jump of approximately 70%. So, and that's not how the industry obviously has expanded. So, we are obviously looking with all these new developments to grow faster than the cycle. Secondly, your first question was on the exports. Exports, we are still, if you look into our LEX business, this year we would be approximately doing 28 to 30 crores in our export business. The other 2-3 components with the same customer are now in production, and I think by next year we should be able to double this revenue what we have planned for this year. So it's going as per the plan. It's obviously in the exports it's a little slower than the domestic speed which is there, but it's going in the right track with this. And then we've added another new tier 1 company for which, as I told you, samples and everything have been sent. It's under validation. We should be starting doing some revenues from Q1 of this coming year with at least 2 of the products. And all these products are very similar to what we are already doing with our existing customer.
Can you give us the tractor and the CV mix in the components business?
Sorry?
Tractor and the CV mix in the components, what will be a broader mix in there? How much is tractor, how much is CV?
Tractors is, you can say for Q3.
Not for Q3, not for Q3, generally for the full year.
So approximately tractors at around 12%, and balance is the commercial vehicles.
Okay. And my last question is on the tipping jack product. 3 years for 2 tipping jack product which has been introduced. What kind of a business size do you see 2 years from now?
Well, next year, at least a year ahead, I can tell you in FY27, we are targeting revenues of approximately 45 to 50 crores. Okay, now this is keeping in mind we make close to an average of around 300 to 350 kits per month. So if you look into that, is approximately 4,000 kits with an average realization value of 1.2, 1.3 lakhs. It comes to around 45-50 crores. This is what we've targeted in FY27. And FY28, once obviously we see, now rolling out 25 parts of these and trying to see what we're going to do 2 years ahead is not the right way. But 1 year ahead is what we have seen. And once we get a better response. We're just waiting for a little bit of validation to be completed. Then we should be able to penetrate faster after 7-8 months.
And just last clarification, your extruded axle is available in the market now, right?
No, not yet. Not yet.
Not yet. When will it be available?
March.
Okay. Done. Thank you and all the best to you guys.
Thanks.
Thank you. Next question is from line of Shubham from Ambit Asset Management. Please go ahead.
Hi, sir. Thanks for taking my question. Congratulations on a strong top-line growth. Couple of questions, firstly on the cost side. We have seen around 80 basis points QOQ impact on the gross margin front. Largely, I believe our gross margins could have been better because steel was soft during the quarter. So what was the reason for that? And secondly, continuing to the first participant's question on other expenses. So largely, if I look at your over the last 3-4 years other expense schedule and filter out expenses which largely appear to be semi-fixed, they are showing a growth of around 35% over 22 to 25, which is in fact higher than even our top line growth. So what is really
can you just repeat the second question again? Your line wasn't very clear. Yeah.
So largely, if I look at your other expense schedule, and if I filter out expenses which largely appear semi-variable or fixed, and I calculate a growth, it is coming to around 35% CAGR over FY22 to 25, which is in fact higher than our top line growth also. Top line growth is around 30%. So also wanted to understand what is really driving the strong increase in other expenses.
So as I mentioned prior to this also, Shubham, on the other expenses, there are few categories which have basically expanded as compared to overall last year Q3. Okay. A few of these include the consumables and the spares, and secondly are certain work offloading charges and power and fuel expenses, and also freight. Now, with the amount of new product lines and new projects which are coming up, for which all the installation and everything has been completed, the trials are running, there is certain amount of expense which comes into things like consumables and tooling, etc. Now, once we see the effect of these new projects and products coming into our top line, you will see that the total percentage of the other expenses starts reducing back to around 22 to 23%, which was there at 24% in the last year. So most of these installations, most of these trials have now been almost completed. Okay. In our axle network also, we are going very strong in terms of expanding our network further. Okay. A lot of our freight is now coming in from the other customers apart from Jamshedpur. Earlier, our largest customer was at 15%, which was local. Today, our local sales in the state are just at around 13%. It's expanded elsewhere. So you'll certainly see once these revenues come from the new product lines from Q4 of FY26 and Q1 of FY27, you'll see that mostly these costs start getting offset into the top line.
Sir, so should we, on a long-term basis, let's say over the next couple of years, other expenses should be in line with how we have done over to FY25, 24-25?
Yeah, I mean, mostly in line with FY25. It's not, we have several cost reduction activities which are always ongoing in our plant. So we feel that it's mostly a lot to do with the revenues coming in now that we've come out of 6-7 weak quarters and we've finally had better results of one quarter, and then we continue to have this trend of increasing our top line by 10-15% every quarter, then you see that the other expenses also mostly fall in place as well.
Sure. So then on the gross margin side?
Gross margins, it's, steel will start seeing an upward trend now. From the month of December, we have already started seeing a little bit of increase in steel prices. The letters have come out, the discussions happening between the OEMs and the steel mills. However, I think we should be able to maintain same gross margins, the fact that we will be compensated by the OEMs for the steel price hikes. But gross margins will vary between these percentages. 1 or 2% up can be there.
So largely, I was actually, I know that steel has now started trending upwards, but for Q3, why was there a 80 bits QOQ impact?
December onwards, you see, mostly when demand starts going up, there is steel price hikes which start coming in. So we've seen a bit of hike in the month of December also already.
What kind of inventory do we hold for the raw materials?
We hold approximately an inventory of 30 to 40 days, especially during a busy month. Actually, the thing is that there are various grades and sizes that we use, Now, there will always be some certain grades and sizes where we are single source to our customers. We have to hold a bigger inventory than the ones that we use on, say, an everyday basis. So it does vary in terms of different grades and sizes. But we on an overall tonnage basis, we do hold approximately 30-35 days inventory.
So just to clarify, your gross margin across product categories would be similar, right? It is fair to assume that since truck components has gone up significantly in this quarter, that has nothing to do with how the gross margin pans out.
Gross margins are mostly similar across. What has gone up is our trailer business. If you look into quarter versus quarter, we've seen a growth of around 21% in terms of our Q3 of FY25 versus Q3 of FY26 has seen a growth of 21%. And the CV component cycle has seen a growth of approximately 16%. That is from approximately 71 crores to around 82-83 crores. So the tractors also have seen an increase only of Q3 versus Q3. It's approximately 25-26%. But gross margins overall are across the industries are relatively similar.
Thank you. Shubham, I'll request you to come back for a follow-up question, please.
Sure, thank you.
Thank you. Next question is from the line of Rikin from Capri Global. Please go ahead.
Hi, sir. Thank
Hi.
you so much for the opportunity. Sir, I have a few questions. Firstly, if you would help understand, in the current quarter, our tractor business you just mentioned has grown at about 25%, correct?
Mm-hmm. Yeah.
So would this...
If you compare it to quarter 3 of last year.
Yeah,
but
YOY.
If you compare it to, YOY. Yeah.
YOY, it is 25%. And if I'm not wrong, the industry volumes in this quarter would have grown at about 35% or so. Could you help understand, is it that some of our customers where we are present have grown slower, or you did mention about adding a new client. So overall, you are at, I think, about quarterly run rate of about 20 crores or so in this quarter. How do you see the tractor business run rate moving going forward? And also, can you discuss about the performance versus the industry?
So, number one, sir, adding a new client, yes, we have, but obviously it takes time to build business on it, right? It starts all with a sample stage, and then you need to set up a dedicated production line for them. So that's only going to come in, if you ask me, meaningful revenues to come out of it is going to be from quarter one onwards. If you look into our performance, in Q3 of FY26 versus Q3 of FY25, actually the total increase has been almost at 29%. Okay, and if you look into 9 months versus 9 months performance, it's at around 16-17%. So we have to look at it at a overall broader picture. I think by the end of quarter four, the increase in our tractor business is going to be upward of 20%. The fact that we usually see good schedules coming in only from April, but this is the first time now we've seen that February also has been very encouraging. The customers, see, we don't have a very big proportion of the tractor business. We are associated currently with 2 companies, now added another one. And total tractor exposure is at 11%, which with the addition of this new customer and new developments with our existing customers, we plan to take it to around 15% to 16% of our revenue in a year and a half time. So that is how the tractor segment is working.
Got it. So tractor components has grown at about 29%, and the CV components have grown at what rate in this quarter?
So if you look into quarter 3 versus quarter 3, we've seen an upward movement of around 16%. Okay, and if you look into quarter 2 versus quarter 3, we've almost hiked by around 70%.
Right. Okay. And here again, what is the trajectory do you expect? Because are you sort of just expecting to grow this business in line with industry, or are there any initiatives which will help grow the CV component business faster?
So CV component business, as I did mention to Pritesh as well in the previous question, that we must grow more than the industry, considering that we have quite a diversified product range. Okay, we do axle shafts, we do coupling flanges, we do anti-roll bars, planet carriers, disc spiders, bevel gears, lot of suspension parts. There are always certain product lines which grow faster with the OEM. Okay, one of them has been our anti-roll bar business. Due to the AC cabin mandate coming in, the customer is using more of these anti-roll bars, and now they're using it in almost 80-85% of their vehicles, which was approximately 40% last year. So there are certain products which are going to grow for us faster than the industry. That is how we should look at it,
Thank you. Rikin, I'll request you to come back for a follow-up question, please.
Okay. All right.
Thank you. Next question is from line of Bhargav from Ambit Asset Management. Please go ahead.
Yeah, good afternoon, team, and congratulations on a good set of numbers. So my first question is that on the exports, you highlighted that you want to reach double digits as a percentage of revenue in FY27 versus closer to 4% as of now. So is this on the back of the new European customer that you are working with, or are you assuming that
the double-digit growth will take us a couple of years? Sorry, sir. It will be basically FY28 is when we reach, by end of FY28 is when we reach a double-digit growth. Right. This year we should be reaching at 5%, and then it will obviously grow to 7.5, and then to closer to the double-digit growth. But even the incremental sales that will come in, say from 5 to 7.5%, is going to be one from the new customer, marginally, because in the exports there is a certain timeline to grow on numbers, but mostly it will be coming in from our existing customer, that is Liex, where we have started the production of 3 more parts that we are doing with them. Secondly is the supply to their other facility in South America. Earlier we were only supplying to their European facility. Now in the last 2-3 months there has been supplies which we have started to the South American facility as well. Plus once we have our extrusion line, as Sumit did mention, is we would be looking at exports of our single piece extruded axle as well. We would be working on that.
So that you are assuming some bit of revenue to come from that in FY28 also, or FY27? Sorry, in FY27 also?
FY27, in fact, by end of quarter, because we are already under some discussion for these products with some customers.
Secondly, sir, on the seamless pipe, in your presentation you written that the capex is completed, but that capex was supposed to be around 170 crores, if I understand correctly, or was that in phases?
No, sir, you're right. The capex for the seamless tube is left. The capex of the IPO proceeds are mostly have been completed. Okay, but there is a lot of part of the seamless tube expansion which is still left out. But that is out of the scope of the IPO proceeds. The IPO proceeds have, you can say, by Q4, by end of it, are going to be fully utilized.
So this around 60 crores of capex that we incurred in the first half, maybe by the year end we should be around 80-90 odd crores.
Yeah.
So this capex next year should be around similar levels, or maybe 60-70 odd crores?
The next year capex levels mostly are going to be towards the balance payments for our seamless tube project, and the incremental capex expense that we need to do every year. But the majority of it, in terms of a new casting line, a new extrusion line, new forging presses, that is addition of 3 presses, these, sir, have been mostly completed, sir.
Okay. And lastly, Rajasthan, Chhattisgarh and Jharkhand are typically our key states for trailer axles, and you mentioned you added 5 new fabricators. Is this are these from the similar states, or you are entering another?
Sumit can take this question. So it's actually, so basically we are strong in these states, and we are adding fabricators in these as well as in the other states, which namely Gujarat and in Maharashtra. The majority of volume growth that we are looking at is going to come from our existing customers, because those are the customers that make the highest volume of that make the highest volume of trailers. So it's from a few states outside Rajasthan, Jharkhand and Chhattisgarh, and 1 or 2 customers are from within these 3 areas. But it's what's more important is that we capture the market where it's growing. I mean, around the country, we capture the market where it's growing, which we are focused on.
Okay, great. Thank you very much, and all the very best.
Thank you.
Thank you very much. Ladies and gentlemen, that will be the last question for today. I'll now hand the conference over to the management for closing comments.
Sorry, we have the closing?
Yes, sir.
Oh, right. Okay, fine. Thank you Thank you everyone for joining this call. Thank you, Mihir, for hosting it. We appreciate everyone's participation. We thank Strategic Growth Advisors as our investor relation advisors. And in case we have any further questions, we request you to please reach out to them, to us, and we can plan that. Thanks a lot for joining.
Thank you very much. On behalf of Equirus Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.